Hello, everyone. Good evening. So today, we're actually very happy to have Mr. Paul Chu to actually have here. So, we will be starting our live at 8 p.m. So, before that, maybe let me just do a quick check. All right. So, if you are able to hear my voice, can you send a hi to me in the chat box so that I will able to see, I will able to know whether my voice is fine or not. Okay. So later on, we're going to start very, very soon. So today, actually, it will be a very interesting topic. So we want to see also how, because just previously, the rates cuts, will it be benefit on the REITs and also property sectors and all that. Okay, so today we actually invited Paul to actually come over here and to share with us on this. So we will be start very, very soon at 8 p.m. All right, we are almost 8 p.m. right now. So before we start, so maybe just do a quick check. So is my voice all right? So today we are very happy to actually invite Paul Shiu, the head of research of Philip Security Research Singapore, to come over to share with us on this very hot topic in the market. So we will go live in 8 p.m. So please wait us for a while. All right, it's 8 p.m. right now, but hold on for a while. Let me just set for the live streaming first. Okay. All right. Hold on, yeah, for 1 second. All right. Okay. So good evening, everyone. So welcome to back to Investing Note live sessions. So today we are very happy to have Mr. Paul Chiu of Head of Research, all right, of the Philips Security Research Singapore. Let me just power up my slides. Okay, share. Okay, so today welcome Mr. Paul to come over here to actually share with us the fall of rates. What is the things that we should take note and how the market's going to react going forward, and what is the possibility of will the US keep on lower down the rate? So before we start today's session, so there's a QR code on the right hand side. This one is our Telegram group. We call it a stock market buddy. So in this Telegram group, we actually share a lot of the information about the market, not just about Malaysia. We also share about Singapore, US, Hong Kong, any interesting news that we found, and we will share with you. So feel free to just scan and join for this Telegram group, and we will keep you updated on a lot of different news. All right. So without further ado, let's welcome Paul. Hi, Paul. How are you?
Hi, fine, good. Yeah, thanks so much. Investing, not share investor. I
Yes.
just want to make sure I get it right because of your
Yeah.
recent merger. And thank
Yes.
you for the opportunity to be here, and thank you for the invitation. Also have to thank everyone here for spending your very precious time for the next 1 hour. So for today, if I can begin, we'll just talk more about
Yes.
Singapore
Yes. Please.
REITs. Yeah. So I understand this is a Malaysian crowd, so we might have 1 or 2 slides that might be a little basic, a little introduction, just 1 or 2, because we are always worried, in case there might be someone new, but just to give some a general sense of what Singapore REITs is. So anyway, our topic now is that for us, for REITs, where we are coming from is that we are looking for value, as interest rates start to recede. For us, value will come from the overseas REITs, not US REITs, but overseas REITs, which we'll elaborate later, and also some of the Singapore names that are a bit smaller cap, but smaller in the REIT scale, because small means they could be still a 2 billion Sing dollar market cap REIT, but I think so we find better value in these names. Okay, we have a usual disclaimer. I usually leave it for everyone to read, but I know nobody reads it, but let me just run through. Usually, this is for education purpose. We rely on public sources. The third paragraph, this is just for general circulation, and the last, do seek advice from your financial advisor. From whatever advice, because we provide some recommendations here. I'll run through very quickly what has happened. Some macro themes, we won't dwell too much on that. Sector trends and some stock picks, conclusion, and hopefully we will have maybe 10-15 minutes of Q&A for everyone. Okay, I only have 1 slide. I don't cover REITs directly, but although I attend most of their briefings, but these slides were essentially done by my my analyst colleague. But before we start, just to give you a sense of how REITs have performed. So this is up to September. I think in October we did see some weakness. Yeah, I think REITs were down probably 3-4% in October. We'll touch about it later. But if you look at this, so what you see here is basically the performance in local currency, how most of the Asian markets perform up to September. So REITs have done exceptionally well the last 3 months, 15%. The ones that did really well were some of the UN, is for 30-40% rebound in that quarter alone. When rates got cut. If there are any questions, I will elaborate why. But what you see here, the last 3 months, what has done well is actually a lot of the ASEAN names, and of course, tech has been the one that slowed down. Last note is that even though REITs have recovered strongly, but year to date, they're still down actually. They're still down maybe minus 0.2, maybe plus the recent weakness, you're talking maybe minus 3% for REITs in Singapore currency terms. So just to give you some macro themes, okay, I will just run through some of the macro themes. So just give me a few seconds. I think some slides were hidden. Okay, but never mind. I think I will just run through as usual. Yeah, sorry for that. Let me just run through it. I think we had some slides on the introduction, but I think I will just skip. Okay, so in terms of the macro theme, the big theme is of course rate cuts have comments. So what you've seen here is for those who may not know, I think everybody knows that the Fed has just rate. So this is where rates have started. So in the gray line, you basically see the Fed rate has started to come off recently. I think they've cut 50 basis points. But the anomaly that you're seeing right now in the market is you can see the 10-year bond yields have climbed up. Likewise for Singapore. So this is the part that is actually spooking the market, spooking the REITs market. Why we say this is spooking the REIT market is because of there were some recent data points where US jobs have been better than expected. There is also the phenomena of the US elections. So the worry is that either candidate wins, but I think if you get a Trump presidency, there is fears that the deficit will expand further, flaming more inflationary spending. The government flaming more deficit spending, pushing up inflation. The US government will need to raise interest rates, and then this is why you get this anomaly. So one way to read this is that even though the Fed has cut 50 basis points, interest rates actually went up in the US, the 10-year bond yields, just likewise for this. For us, when we look into the inflation numbers, we think inflation will still be hot for the next 2 months. And this will put some headwinds on REITs because there will be some uncertainty how aggressive the Fed rate cut will be, but we think inflation will start to really fall sharply in the beginning of next year. So in terms of where the market expectations, even though bond yields have climbed up, there's a bit of a inflationary wave right now because China has started to do fiscal spending, US dollar is weak, all price have come up, although it's down recently, but it's still up. So I think there's a bit of a worry of an inflation wave happening. But nevertheless, I think the market and for us, our base case is we still think there's going to be 2 more rate cuts in the November and December FOMC meeting. So there's two more meetings left for the year. So there should be 2 more rate cuts, and there should be at least 3 rate cuts in the next 6 months. Or for the full year, so this is where we are right now. So this chart basically means this is where the interest rates are. This is where we think it will end, and then this is where we think the market thinks this year. Sorry, this was September. This is where the market thinks interest rates will be by the end of this year. So from here to here, you're talking about another 100 basis points of rate cuts, roughly. So there's still at least there's still at least 6 more rate cuts coming until year end. What the market is following now, I don't want to bore everyone with the macro, but what the market is following now is actually the red line here, which is the Federal Reserve's expectations. Because what the Federal Reserve is guiding is just to follow their so-called dot plots, which is the base case for most investors. So there still should be 2 rate cuts coming up. And if there are more questions, feel free to post them later. So in terms of the sector trends, just to give you a sense, so the key highlight, the key debate that everyone is asking now is, of course, interest rates are down. What's going to happen to the performance of the REITs? So this table basically shows how REITs perform in the first half. So one way to understand it, as you can see, most of the REITs are actually in red. So even let's say you take, so even though Keppel DC, even though their NPI, basically their income, you can think of it like the net rental that they collected from all the data centers is up 4%. But you can see that even then, their dividends are still down 10%. But that's because of the pressure that they are facing from higher interest rates. So what it means that even they cannot outrun the high interest rates, no matter how well you do. I mean, this is even more evident like Capital and Escort, even though they grew, dividends were down because there was a bit of capital raising. So only a few REITs managed to grow their dividends. Largely, a lot of it is hospitality and some of the large like capital commercial, which is a bit of office and retail. But then, so even then, we only in the third quarter so far, you still see REITs in the red, although not so dire like this, like 20%, but you're still looking at maybe 2-3% decline in interest rates for the second half. The growth we think would come in the 2025. So that's one of the reasons why REITs are being re-rated, because after you see all this rate, 2025, you should start to see some growth in REITs, and that's what's triggering the outperformance. This table here is just to show who didn't hedge out their interest rates. So for like the most aggressive is okay, the least aggressive is like, let's say you take Cecil. So Cecil has basically hedged out all their interest rates. So even though interest rates may come down, they may not benefit because they've already fixed all the interest rates. The most aggressive is Far East. So basically, Far East Hospitality is just taking a bet. To them, they say interest rate is coming down. I'm just going to keep all my debt variable. That means if interest rate come down, I'm going to benefit. Likewise, if it goes up, I'm not going to benefit. But they are the most aggressive based on this chart alone. So in terms of valuations for REITs right now, one way to look at it is basically how much yield they're collecting now. So right now, you're probably looking at the high fives because of the recent week. This was up to September. So REITs are right now probably 5.8, 5.9% dividend yield that you're collecting in general for the whole market. And the dividends should improve. So this yield could hit 6%, assuming the share price doesn't move. But okay, then in terms of valuation, so of course you will say, okay, interest rates are up, but so what? Dividend yields are up, but so what? Interest rates are also up, so I can put money in FD rates, but in fixed deposit. So one way to see whether is REITs paying me the extra premium, because if I put money in the REIT, I should get higher than what I'm getting for FD. So this is one way to measure it. Of course, we use 10-year. It sounds more sophisticated, but you can just use FD rates. Is almost the same. In terms of the understanding of it. So if you look at this, so right now you're looking at maybe around almost 3.3% of a pickup. That means if 10-year might be paying you 3%, the dividends are paying you extra. So of course, the higher it is, the better. So right now it is slightly on the low side. On the yield spread, I wouldn't think that it is cheap, but the difference now is that interest rates are coming down, so the bond yields should be coming, your FD should be coming down, but at the same time, your dividends should grow. So it looks expensive, but at the same time, the yield for a dividend for a REIT can grow, whereas for FD is likely going to come down even more. So for me, although it looks expensive, but I think if you forward, it should actually come back to average. So from that sense, REITs are not expensive. In terms of valuations, so this is basically how REITs are valued compared to the market value now. So let's say a property might be worth, I don't know, 1 billion. On the REIT terms, it's probably worth, on paper, it's about 900,000. So it's coming back to the mean, which is around one time, slightly one. But those that we recommend are way below. Some will recommend like probably 30 to 40% discount to book. So that's why those are the ones that we find value in. So this is a very complicated chart, but we thought it was also imperative to kind of put it in just to give you a sense. So this chart is just to understand, so the question is, okay, interest rates, if you see it on this orange line, so when interest rates come down, should we celebrate? That means all the REITs should rally, and it's time to celebrate, because the interest rate come down, shouldn't REITs perform, should just run, but it's not all the time. Of course, we wish it would, then it makes our story easier. But if you look at the global financial crisis time, the orange line is interest rate. So you notice that when interest rates come down, REITs actually come down. So and of course, this happened is when you have in this period was unique, because this is when global financial crisis, when economic conditions are really dire, it's no longer about you collecting yield. It's about whether can you repay your debt, because as you all know, the REIT model, global financial crisis, there was the worry that you cannot refinance. Something similar to the US office REITs now, but because of that, you will notice that the interest rates have been. You'll notice that that's why the performance has been being. Apologies if the internet is a bit shaky, but you'll notice that when interest rates come down, it doesn't mean REITs should rally. It also depends on economic conditions. This was unique, this global financial crisis, right? So the worry was whether REITs could survive because they cannot refinance the debt. The other time when interest rate came down, REITs also suffered, but this was during SARS time. I mean, this is when all the malls were shut. But for us right now, So, and when interest rates climb up, of course, then you'll be thinking, oh, well, we should sell all the REITs, but it didn't. But actually, REITs can rally too in this kind of environment, because economic conditions. So it's not always the simple case of just interest rate come down, REITs can rally. But for us, we think this time it can, because we are not having a global financial crisis period. Neither are we having COVID. I mean, touch wood, we're not having such dire economic conditions. In fact, economic conditions are quite resilient and actually still improving for most sectors, or not every sector. I'll move on to gearing. So gearing is generally stable. It's only those above 50. So for those who do not know, the MES rule, or the Singapore Central Bank rule for all REITs, is that once you cross 50, of course, this guy crossed 50, you cannot borrow anymore. I think so it used to be 45, then they moved it to 50. So that's why for this particular Manulife US REIT, that's where they stopped paying dividends because of that. So this is something that we monitor these days. And the other thing why you monitor this is that if it's too high, like if you're hitting 43, or 44, you get to worry whether these REITs need to raise or equity fundraise to actually to actually lower their gearing. So this is just a chart that this is one other thing that investors also look at, which is the gearing. Breaching covenants, loan covenants is mainly more for the US REITs rather than this. Okay, I'll run through some of the sectors before I move on to the stock. So for retail sales in Singapore, in a nutshell, it's not fantastic. I mean, look at this chart. So this is retail sales index. It is not fantastic. It is basically growing at maybe 1-2%, which is back to the pre-pandemic Singapore, about 0.2. So REITs, retail tenancies in general, very largely, is not at very robust levels. In terms of hospitality, so hospitality is still performing well. You notice here, but it's not all good news. So from here, visitor arrivals is still growing about 12% in Singapore. We are still getting a lot of tourist arrivals, but this is I don't know, double the level pre-pandemic. Pre-pandemic, visitor arrivals in Singapore was around 5%, so we are still like double the pace. The problem for hospitality is here, because room rates are not increasing. One of the reasons I'll show you a chart later is because of there's a bit more supply coming in. And there was a recent call at OUE REIT. So and they own the Hilton. So for them, they mentioned that China arrivals are still there, but they are not spending. So the spending power for visitor arrivals isn't as high. So spending on luxury items and also spending on high room rates, because they are a luxury hotel, or almost a luxury hotel. I mean, for Hilton, is not technically a luxury, but I think if you're in Orchard Road, you are. So there is some resistance to the high spending. So actually, hospitality is starting to flatten out a little bit, although you notice visitor arrivals is actually improving. The next is office. So for office, it's actually more positive for office. So although you notice, so this is basically a chart of the rental in Singapore. But why it's positive is that most office REITs, their tenancy is usually 3 years. So most of them renewed their rents at these levels. So because 3 years, right? So most of them renewed their levels at maybe 1080, 1090 during just when we were still in the pandemic. So 3 years later, you by default, so these were all below market rents. So that's why office REITs in Singapore are doing well right now. Number one, because most of the rents were done during pandemic, maybe $11 or slightly above. But right now, rents are moving towards the $12 levels. So you get this automatically back to normalization of their rents, because most of it was done during the pandemic. And number two, the funny thing is that the economic environment isn't fantastic. So a lot of office tenants, ironically, because of that, they're not looking to move. So actually, tenant retention ratio is very high. Because for a tenant to move, they have to spend a lot of capital, renovation, expenditure, and all that. So a lot of them don't want to move because you have to spend the renovation. Alternatively, the competing landlord, which is IOI, which is the largest one coming up, they are already hitting 60% occupancy. So they are also not trying to incentivize tenants to move. So because of the high capex involved in moving office, so that's why the tenant retention ratio is pretty high, because supply is also constrained. So these are the two reasons why I think office rents, although it's plateauing, but when you do the renewals, it's still growing at maybe high single digits. Industrial is right now is still performing very well. But for general warehousing, it's still doing well because the export sector has been performing. But we are a bit more cautious, because as we right now exports are doing well because there's a lot of stocking up in the US before the elections. But that's why we're not really not much visibility post that. But right now, as you can see, the industrial index is still climbing. It's still growing, but we think it might be just the pace of growth won't be as high as the last 2-3 quarters, because we're just a bit more mindful of the economic environment, especially for the export sector. So that's why we're a bit more cautious on industrial. For hotel, there is a bit more supply coming in. So this is the amount of room stock, and this is the upcoming supply. As you will notice, because of the pandemic, obviously there was no supply. There's some supply that came up to about 5-6%, and then it's starting to normalize. So 2025, 26 onwards, that's where the office supply, the hotel supply will start to normalize. But we also think this is placing a bit more pressure, because some of these are all luxury or hotel supply. Move on, the last one for data centers. So data centers is probably the hottest area right now. So this is basically a chart of demand versus supply. So you can see that the utilization continues to climb because demand is strongly outpacing supply. So just to give you a bit of tidbit, so like for Keppel DC, for the last 2 quarters, their renewals, the rental renewals, that means from the previous, their renewals, actually the rental reversions were up 40%. That means the tenant has to pay additional 40%. So of course, this is not every data center is going to do that, and that's because there's very limited supply in Singapore, and the demand is insatiable. You can't meet it. But in generally, there's still strong demand for data centers, and the take-up rates they're all hitting 100% utilization rates. Okay, I'll move on to the stock picks. Okay, so I'm just mindful of time. So for our stock pick, the one that we still like is actually Comwell European REIT. So Comwell owns about 110 properties. Most of the properties you can see is all in the shaded area. They are in Western Europe. Most of it is logistics, industrial, and so there are basically 3 reasons why we liked it. I mean, even though there was move on to the next slide. So even though Europe had all kinds of issues, I mean, you can pick any issue you want. I mean, there was a war, obviously, war in Ukraine. Inflation spiked up. We all know that inflation spiked up, especially in the UK. Interest rate also shot up. So even then, you will notice that their occupancy levels are still really stable. So in a way, for us, we like Cromwell because they've been really stress tested. You can throw anything to their portfolio and they basically survive at 95, 96%. And the yields are also 8.5. And the third reason is ECB already cut twice. So we think, or recently cut again. So with that, we think the interest expense is going to come down even more, and that's why we're positive. And probably the level of interest rates could even come down faster than the Fed, because the economic conditions in Europe are even slower, and the inflation there has come off even below the ECB's 2% target. So that's why for us, we like it, because the portfolio has been stress tested, even though all kinds of adverse scenarios. The yields are still attractive at 8.5. You will notice that the DPU came off, but the DPU came off was almost intentional, because they wanted to have a strong, because they had a big renewal coming up in 2025. So that's why they wanted to sell an asset, and to make sure, they sold an asset to make sure that there is no risk of a refinancing. So that's why the DPU came down rather than the performance of the portfolio. But now that liquidity conditions has improved, we think there's upside to the dividends, to the DPU growth. Although we have already, so this yield takes into account the weakness in the dividends per share. The next one we like is CapitaLand Escort. So we like it because the yield is 6.5%, and they are geographically diversified. So they have 102 properties, the assets about 8 billion. The share price has been stalling somewhat recently because they did a placement. If I'm not mistaken, about 120 there was a placement. So that's why the stock has been kind of moving sideways. But we still like it because the yields are attractive and they have assets all over the world. And the other attraction we had was that some may follow, some may not follow, but most times when they divest an asset, because of the locations are also, because when you own a hotel, the locations are all they're all very well centrally located. They can generate like almost 20 to 50% gain on above valuations. So we also like it because there's a lot of hidden value in their assets. So not many REITs can sell properties at 30 to 50% above valuations. So the value obviously we always kid either the value should be sacked or there's a lot of hidden value in their properties because some of it can be used for development. So that's why they always have a propensity to kind of sell assets at a huge premium to valuations. And we continue to see the RevPAR growth, although it's already stabilizing. So we're not expecting like very high growth for RevPAR, maybe stable, but we think the yields are attractive, and with interest rates coming, there's room for this to grow. The next one is OUE REIT. So for OUE REIT, they own a prime office and retail in Singapore. The yield we think is still attractive at 6%. They just came out with their results. So it's a bit of a mixed bag for them. Like we mentioned, office is still doing well. Retail is still growing, but a bit slower, maybe low single digit, the rental reversions. The problem for them is the hotel that they have, Hilton. So that is starting to come down a little bit. They are facing two pressure points. Like we mentioned, hotel rates are the RevPAR is coming down, probably low single digit, and they're also facing a bit of labor cost issues. Because one thing different for hotel is that they take a cut in the operating profit. Not much, I mean, but it's still, there is some element of the rental from the GOP. So this part of the business, I think, is 20%. Hotel is about 20% of the business. Office about 50 plus. So even though it's slow, but the growth in the office will still carry, and we still think the DPU will be stable. And this is assuming there's no change in interest rates. So we still like it because most of their assets is in prime levels, and they are still trading at 0.5 times price to book. Even though most of their assets are in Singapore, they have probably 10% of the assets in China, or 7%, sorry, in China, but no, 93% of it, and we think the valuations are very attractive because they are still IG means they were investment grade. So they issued a bond, and the bond was given investment grade rating. So this table is just to show that among all the investment grade bonds or rated REITs, they're the ones with the cheapest. So so that's why we think there's a lot of value in this, because they're trading at let's assume 50% discount to their valuations, to the book, and they're trading at a 6% yield. Okay, move on to the next one. So so for those who really believe that China is recovering, this is probably the REIT for you. So this is the first outlet REIT listed in Asia. So they are virtually an outlet mall, and in China. And of course, this particular retail concept, we think, is of course growing faster than a typical retail mall in China, mainly because of down trading, because of the weak economic conditions. A lot more consumers are shopping in outlet malls. Their outlet malls are a bit different. It looks more like a mall. For those who have gone there, it looks more like a mall than the typical US outlet malls. There's entertainment, there's restaurants, there's a lot more of a mall element in it. But anyway, they're benefiting because outlet spending is outpacing the general China retail spend. They also have an attractive 8.7% yield. They are trying to capture some of the Chinese, the lower interest rates in China, but that might take some time because most of their loans were offshore. So they didn't have much China loans onshore. So it will take some time for them to, because interest rates in China now is about 2%. So everyone is rushing, like MLT, everyone's rushing to capture some of the cheap debt out of China. But for them, it will take some time because they really hedged out some of their debts. But why we is why we say it's one of the better ways to play China consumption is so they take basically this is a pure, they take a cut out of the tenant sales so when the tenant sales go up, they will do well. So this is one way to play the Chinese consumer spending, but you get paid for it. What we mean by that is that whatever rent they collect as a share of the tenant sales, they will pay out as dividends. So it's not like a consumer stock that they pay, they earn, right? They provide strong earnings, but they don't give you dividends. So this one is really when they will take a share of the consumer spending or tenant sales, and they will just pay, they take it and just pay the investors the dividends. So after the pandemic, we do see tenant sales recovering. We think it's just going to grow slightly above the pre-pandemic levels. But again, this also shows they managed to survive the pandemic in China. So for us, we also like it because, again, stress tested. I mean, after COVID and you for retail mall, you're still around, I guess you kind of been stress tested in China, especially since they don't really give much incentives to the malls. Okay, they managed to survive also because the sponsor supported the company during the pandemic. Yeah. Okay, the other one is Suntec REIT. It's also another way of playing the Singapore office and retail. They have 12 billion assets. So for those who do not know, they have office, retail, and convention. They don't have a hotel, so that's the difference with OUE. And for them, most of their properties, like 70% of their rental income, all come from Singapore. Australia, that is a bit of a problem. That has a bit of a good for all Australian office in general, because of work from home phenomena and also supply conditions. Office is a bit more troubled, but for them we like it mainly because not so much the yield, mainly because their price to NAV is also cheap, trading about maybe 0.55, 0.6 times. So again, another 40% discount to book, but they have the lowest hedge. So they were the ones that the DPU got hit the most. That's why the yield is so low, because their hedging of interest rates was very low. That's why when interest rates spiked up, they were fully exposed because they didn't hedge. But right now, when interest rates are coming down, we think they're one of the beneficiaries. And of course, you have the huge discount to valuations. And they are also trying to de-gear as they sell more and more of their assets. So that's the other stock that we like. So for Elite, it's a UK REIT. For Malaysian investors, you probably may know that their shareholder is actually Sunway. So if you want UK exposure for whatever reason, also because this is traded in pound sterling, they have 150 properties, but 145 is freehold. So this is not these are not technically shop lots, but basically they look like shop lots in a way, but most of them are actually rented to the UK government, where the UK government will when it's like a community center, I like a better word, for those who want to go there for community activities, if you want to go and collect your pensions. But ultimately, their main tenant is from the UK government. Of course, doesn't mean UK government, of course, they won't default, but they can return some properties, which has happened. But actually, after they return, they managed to sell some of the properties and even developing some into data centers. Okay, I'm not saying everyone's going to be a data center, but they are working on one of their properties into a data center. So we like it too because the UK has started to cut rates, and also we like it because the dividend yield is attractive. And again, it may not be suitable for everyone because you're talking about British pound sterling, but we think the yields are attractive. And of course, the valuations are also below book. So like typical for our strategy, we just want to buy things that are below book and still pays an attractive dividend yield. Of course, you might be asking why some of these overseas REITs are still trading attractive, because in general, most of the liquidity actually goes to the larger REITs. You're talking about the maple trees and maple trees because of institutional funds tend to gravitate towards the larger REITs. But for us, we find better value in some of these overseas REITs or even Singapore REITs that have attractive yields and trading below book. Okay, the next one is the next one that we like, which also pays a high yield, is Far East Hospitality. So Far East Hospitality is a pure Singapore hospitality REIT. So it's a proxy to Singapore hospitality, because there are not many not many REITs in Singapore that, or hospitality REITs in Singapore that is purely on on Singapore assets. So most of them, like Ascott, they might be in multiple countries. Likewise for CDL Hospitality. So we like it because they've got 9 hotels and they are not the luxury kind. Okay, so they are more, you can call it business hotels or more affordable, the mid-range hotels. So like we mentioned, some of these like Oasis, probably some of you may not even know, or Rendezvous Hotel, but these are all well-located hotels. But we think this is probably the sweetest spot to play if you want a pure Singapore hospitality, because if with the Singapore dollar rising, and if tourists are more sensitive to spending, so we think this will be the better picture. And again, there are still many more attractions coming on to Singapore. The 2 IRs are undergoing each about Singapore $7 billion of renovation. So there's still going to be many attractions coming up for next year, and we think this will keep the tourism spending in Singapore to be vibrant. So these are most of the locations, although they are not they are 5-star hotels, but they are still located in the Orchard Road. They are located in all the major Novena medical hubs, where IHH hospitals are, your parkways and so forth. And they are all located, some of them are located near Marina Bay and Singapore River. So that's why we took out these pictures to show you the locations. They're not in some northern Jurong part of Singapore. So they are near the Orchard belts, but they are not considered like your ultra luxury. And this, in a way, is the sweet spot for hotels. The next is that we are begin. So this was the recovery that they had, and we still think that the RevPAR will not will still grow, but a bit more stable. Then will outperform the rest, but we don't think it will be that stellar growth, obviously. But you're still looking at maybe 3 to 4% kind of growth for Far East. So it's more resilient, and they are paying a 7% attractive yield for us. So I'm going to end it soon. So for us, in conclusion, we still think that for the REITs, it's going to be muted DPU growth in 2024. But we think, how we see is that if there's 100 basis points cut in general, not for every REIT, but if there's a 100 basis points cut in interest rates, we are looking at a 5% growth in DPU. And we still find the valuations attractive because most of them are trading below market valuations. And then we think inorganic growth will start to pick up. And we're beginning to see some of this inorganic growth. The key thing for us, the capital management remains the top priority, which I think is probably self-evident. But just one thing, so in general, why REITs are the most leveraged, they benefit the most where interest rates come down, is firstly, of course, number one, interest rates come down so the dividend can grow. Number two is also the valuations can grow, because once interest rates come down, your cap rates will come down, and that will prop up the valuations. And number three, when bond yields come down, you will only make REITs more attractive, because if interest rates continue to come down, or your FD rates start to come down, I'm just using FD rates because if I say treasury bonds or Singapore bonds, it may not be less understandable. But when interest rates start to come down, yields start to come down, it will just make a 6% dividend yield of a REIT more attractive. And of course, a REITs also attractive if economic conditions tend to slow. So again, we favor REITs. Our selections are those with healthy balance sheets, strong sponsors, and also improving operating metrics. I apologize that there were 2 or 3 slides that were hidden because this was some of the basics on Singapore on REITs, but I think I didn't screen this shot. Thank you. And also, if you want to join our community, so this is our P3 community, where if you have questions, you can post in our community, and our analysts, if not me, our analysts will try to address some of them. So this is our own community for our Philip users and so forth. So thank you everyone for listening. I apologize, there were 1 or 2 slides I should have shown on.
Hello.
Okay, yeah, thanks. I think I stopped sharing. Yeah, thanks, Aaron.
No problem, no problem. To the few sites, I think right now we can have some time for Q&A, right? Let's say if you have any questions, feel free to put into the Q&A, or there is a chat button in the below. So you can always put your question inside. Then Paul is here to. Right now we actually have some time. We can actually share on that as well. So in the meantime, Paul, let's say if you are able, because I think your slide to see whether we were able to unhide. Let's say if you unhide, then you can share
Okay, sure.
also.
I can unhide it for you. So
Sure.
give me a minute.
If let's say
Yeah.
at the same time, maybe we can take a look to see is there any questions regarding REITs or regarding Singapore companies, or any questions that you want to know more to discuss further as well. Okay, so there is one questions from is an anonymous person who asked, is our audience. So why is the reason that DC REIT is popular where their yield is only 3 to 4%?
Yeah. Okay. So for DC REIT, not only are they 3 to 4%, their price to book is like 1.7 times. I I think so. The funny thing for
Hello, hello, Paul. Hello, Paul. All right. Hold on, yeah. Hold on, yeah. So right now, I think Paul, internet is a bit.
yeah
Hello,
yeah.
hello,
Sorry,
Paul.
can you hear me? Yeah. So sorry.
Yes. Your line just now is lag already. So right now you are back. Yeah, it's fine right now.
Okay. Yeah. Okay. So yeah. The one, yeah, I think that the why is trading so high. There's a lot of excitement uh about the ability to grow the REIT because the data centers, the demand for data centers is so high. But for us, you notice I didn't put this up because we still think that it is expensive. So one of the reasons, the benefit of having a very low yield is that you can make an acquisition. So you can imagine if you are valued at 1.7 times price to book, you can acquire any REIT at one time and you can make it accretive. So people are expecting a lot of inorganic growth from Keppel DC. But for us, we still find it expensive. So even though there was a lot of excitement, so I'm just trying to export my thing. Sorry, there's a lot of there was a lot of excitement behind the Keppel DC because in Singapore they managed to push rentals up 40%, which is unheard of. I mean, you just tell a tenant, I'm up 40%, but even they did that, the DPU only ran up by 1 to 2%. So that's because it's only a small part of it doesn't mean the whole portfolio gets renewed. So for that, we think it is still too expensive. Maybe digital call is probably the better alternative. That's why for us, we still have a neutral call on Keppel DC REIT. So that's the reason. Yeah.
Hmm.
I hope I
Uh,
answered it as a very long video.
no worry, no worry. Thanks for all that. So another second questions, right, is how do you see First REIT and Parkway REIT? So he also mentions
Yeah,
that it's also with a low yield.
yeah. Parkway REIT, our Parkway REIT has a premium rating, a bit more justified because of the structure of their tenancy. So there's a big inflation adjustment that they have with Parkway. So it's inflation adjusted. I mean, if I can get this type of inflation adjustment in my tenancy, I will just be smoking. I'm not advocating smoking, but I'm just saying I'll be like smoking a cigar every day because it's inflation adjusted. And because their parent is Parkway, so that one I can understand the justification because you got inflation adjusted. So even though they managed to grow, so that's why the valuations can trade above so high and the yields are so low. And with that kind of yield, the irony of it is that if So as an investor, that is the issue you're going to have. If your yield is high, like those that we mentioned, yeah, the yield is high, I get a return, but it makes them very hard for them to make acquisitions. But if your yield is low, you get this a virtuous thing. My yield is only 2% or 3%. I can acquire virtually any private asset out there because anything I acquire will be accretive because I'm so low. It's only 3%. Then you get this virtuous thing. I can acquire more, grow my DPU, make myself bigger and bigger. And with size, you actually attract more liquidity. So that is why, even though the yield is low, there is a benefit of having a low yield. Ironically, I mean, so the worst is to be in between. I know you're not so attractive, at the same time you're not attractive enough to buy. So yeah.
So how about first REIT?
Okay. So first REITs yield isn't that low. I think first REITs yield is pretty high, but if you buy first REIT, the view you must take is you must have a positive view on Indonesian rupiah. So after the recent restructuring, so just to give a bit of backdrop, because a bit of a history for First Street. So First Street used to pay in Sing dollar, but that was not tenable because that the reason why they could pay the Sing dollar, although Indonesian rupiah, it was, I wouldn't say collapsing, but it was really dropping very sharply, was because they managed to get they managed to get the parent, which is Lipo Karawaci, to top up any difference. So virtually it was a bit of a financial engineering. So when they removed that, right now there is still a little bit, but right now whatever they get from Siloam, the hospital, they get in Indonesian rupiah, and they will just pay you in Indonesian rupiah. But the backstop to it is that every year there's like a 20% minimum, or 4%. Sorry, if I got the numbers wrong, either 2 or 4%. There's a minimum escalation in rent. So that was meant to kind of backstop the weakness in rupiah. So investors are protected in the sense that there's a minimum increase in rent for you. So for first REIT, the other upside you get is that if you also get a share in the revenue, or sorry, on the revenue or profitability of the hospitals. And I think 2 or 3 of the hospitals is that. So there is a optionality, upside optionality. That means if the hospital do really well, you're not only going to collect rent, you're going to say, hey, you better it's like almost like your GOR, gross revenue. You take a cut of the revenue too, or profitability. So that's why the attraction. But you must have a view on First REIT. For us, we like it because healthcare is doing really well in Indonesia. So that's why we have a buy there, and we think that incremental escalation per year. Sorry, I think it's around 4%. That incremental escalation per year covers the weakness in rupiah. Yeah, sorry, it's a very long-winded answer. Yeah.
No worry. Okay, all right. So let's see. Is there any other questions? So if it's not right, actually I have some questions, right? So on US they declare on the interest rate drop, all that kind of things. So and based on Singapore, there's 3 banks, right? DBS, OCBC, and also UOB. So and I think for this year, these 2 banks, I think DBS and also OCBC have gone up quite a bit. So what's your view on this, Paul?
Okay. For banks, we think the earnings for third quarter, fourth quarter will still be strong. So for banks, you either make money from lending money, or you make money from capital markets. So that lending money part will be stable because interest rates come down. So it won't drop off. Probably only in the second half of next year, because they kind of hedge it out. So we think the earnings will be strong because of capital market activities. So capital market activities will be strong because, number one, wealth management. So most times wealth, high net worth comes in when interest rates were high. They just put in FD. I mean, I'm already getting 5% in FD or 4% FD. Don't ask me to do something else. But right now, when interest rates are coming down, as they move into investment products, then the banks will get more margin. So that's number one. Number two, of course, the last few months, capital markets volumes has been very buoyant, so they will get that kicker too. And of course, when you see all these REITs having more activity, corporate finance, so there's a lot more capital market activity that will benefit the banks. And number three, if you recall, when we had that yen carry trade disruption, there's a lot of FX volatility recently, even up to September. So the bank's trade income will also do well because clients will ask them to hedge more. So we think the third quarter should also flow through to the fourth quarter. Bank results would be strong. It's only second half of 2025 where you might get a bit sluggishness in the earnings. Because most of them have hedged. So if you think of a bank, they collected so much deposits. So what do you do with it? So you can either put it in very high short-term deposits that might earn you. I'm just giving a number, maybe 5%, or you can put it in very long-dated bonds for 4%. So a lot of them did that. So a lot of them locked in at maybe high fours, mid fours. So that's why they are protected. Weighted average, they're protected up to first half. So they can, so even though interest rates might drop up to at least the first half, they're still fine. Then second half, depending how steep the Federal Reserve cut rate. So I think banks will still do well. So you should expect in the near term, earnings should still be pretty strong for at least this year, second half, purely capital market activities.
Okay, all right. Thanks, Paul.
Yeah, sure.
Okay. Okay, so so let me know if you can actually put into the chat and also the Q&A to see if you have any questions regarding the stock market or anything, then or what are the things that you want to learn more, then we can actually discuss further from that. Okay, so Paul, I think we were able to unhide the slides. If not, I think it's fine as well.
Yeah, sure. I will just share screen. Yeah, so I
No,
mean, this
don't
is
worry,
more
don't
of a
worry.
basic, a basic part, but I think I wanted to show this because this is a Malaysian audience. So I'm not sure if everyone understands. So, anyway, can you share the screen?
Yes, I can see.
Yeah. Okay. Anyway, this was the hidden part. We usually don't do this because if it's a Singapore crowd, we will remove this. But if and we normally don't do introduction slides, but for this or even for some of the REITs, because most know. But anyway, just to introduce for most of the viewers, if you're new to REITs, so for Singapore, there are around 41 REITs in Singapore. Market cap about 90 billion. So we are the largest REIT market outside of Japan. I think Australia should be bigger than us, but so we, and the one thing unique is for us that we have all kinds of REITs. I mean, you can like pick your poison in a way. Most of the REITs pay quarterly, but at the minimum, of course, all of them will pay semi-annually. So just to give you a flavor, most REITs actually have some assets overseas. So there's very few pure play REITs that are in Singapore. Maybe like we mentioned, Frasers Hospitality, Frasers Centrepoint. They seem to be all Frasers, but sorry, the one is Far East Hospitality, the one is Frasers Centrepoint. So these are the ones that are a bit more pure play, but most of them have some exposure, mainly in Australia or UK. So we have a vast spread of REITs. So we have industrial, hospitality. Some are integrated, so I'm not sure where they fit into here. I'm not sure how they. So a lot of the REITs also have turned integrated. So like OUE REIT, they have hospitals, retail. We always ask them, do you actually, does that help reduce your cost of capital? Maybe not, but I think the size does. But so we have also healthcare, like someone mentioned, the first REIT, Parkway. These are all other REITs. So what's the benefit of investing in REITs is, of course, the taxation part. They virtually don't pay any tax if you structure it over the REITs. But I mean, if you're a REIT property owner, the problem now you have to pay the REIT, the trustee and the REIT manager something. So it may not be so beneficial if you're a real REIT owner, but at least you don't have to pay for the tax. You have exposure to global asset classes. So most of them can invest in Australia, like I mentioned, UK. We have even Japan REITs. We have REITs, and most of them have high yield. And of course, the benefit of a REIT is that if you think economic conditions are coming down, then REITs are less economic sensitive because you're collecting rents. Unless, like we showed you the chart earlier, unless you're talking about real deep recession, that's when the risk of refinancing will emerge, and that is happening, I guess, for some of the US office REITs. But excluding that situation, most of the rental reversions in Singapore will generally be positive. So it's just a degree whether it's low single digit or mid single digit. When you say rental reversions, means your renewal of your rents, basically when your rental is due. That's to give you this was done a few months ago, but at least you can see that REITs generally pay higher yield. They are higher than the benchmark. That's why there's always a spread, and they are generally better than the STI index, which is the Singapore index. Okay, yeah. Anyway, this is what we just wanted to show some introduction. Again, I should have shown this earlier. Yeah, for those who may be new to Malaysia.
Thanks for sharing. All right. So let me know if you have any questions on here. So I think okay, there is one questions. Your recommended local REITs is relatively smaller size than other bigger REITs like CapitaLand and Fraser. Any reason?
Yeah, basically we just find better value in these REITs. I think when we initiated on OU, just to give you an example, I mean not everyone, but when we initiated on OUE, I think was like low 20 cent plus or something, or high 20s, which everyone say, no, why you initiate this? So for us, we're just going for where the value, although the share price is up like 20-30%. But for us, we just think that there is the value here. But we know the challenge that you face, because the flows and as you know, flows are not dependent on fundamentals, just on who is bigger, the size. So for us, we just find bigger attraction in some of these smaller REITs. And just as a side note, even the large REITs, like I'm just talking Mapletree Logistics because I just listened to their call. So maybe my memory is better for this. But even if for them, they are so large, interest rates are still going to hurt them. So because they are so large, they hedge out a lot. So they hedge out, and even though interest rates are coming down, their interest rates, they've really guided, it's still going to be rising, even though there are rate cuts next year. That's because they spread it out so well. They hedge it out so well that they won't get any benefit of the lower interest rates. So it doesn't mean that you get the larger REIT, you do benefit from lower interest rates. So for us, we're just looking for value. We think the yield is there, and when the yield is high, you actually can defend the stock. I mean, if the yield is like 8-9%, I mean, not going to push it down to 10. So that's where we are coming from. We just prefer this because we find them more attractive. Yeah.
All right. Thanks, Paul. I think the time is almost there also. So do you have anything else would like to share with the crowd over here for tonight?
Let me just try to answer this one very quickly. What is the view on industrial or logistics REITs compared to in industrial? I'm a bit more cautious because we think export environment is not that vibrant, especially if we move into 2025. And now, if you assume there's a risk of a trade war, I mean, no, it's all speculation. If Trump really imposed tariffs, then I think industrial might get hit. Logistics is attractive. So most logistics are doing well because of e-commerce. I know e-commerce is nothing new. Everybody's heard of it, but e-commerce is doing well. Warehousing is doing well because supply chain there is still some stocking up. Although the feedback we get is that stocking up in Singapore is pretty expensive. But anyway, we think logistics still doing well. Retail, yes, retail, it will still benefit, but it will still be slow. I'm talking about low single digit. You still get a bit of a headwind, tailwind now, because most of them are still they're recovering from the pandemic type of rental and hospitality. So in general, most rental reversions are probably, I'm talking 2025, probably like mid single digit. There isn't, maybe office might be a bit more stronger because of the reasons I gave. Yeah. But I prefer probably logistics will be number one, and then retail 2, then 3 hospitality, then industrial is probably the 4th. Yeah.
All right. Thanks, Paul. Hold on. Yeah. Let me just do a quick share. Okay, all right. So just to share a little bit more, so you guys know we are the social media platforms for anyone who are interested to discuss not just about investment, how do you manage your own money, how do you build your portfolio. So all these, feel free to come and discuss with us. So we have a lot of information on the stocks and finance as well. So our core is actually the community. So there are a few features over here that's free for you to use: stock calendar, portfolio, some of the insights, charts, and also price and alerts as well. So we're available. You can just type www.investingo.com. So it's available on website, or you can download our app to use as well. All right. So once again, I would like to share, this is our Telegram group, Stock Market Buddies. Feel free to join for this group and share with us what's your view. And we will also share some of the news and updates on this Telegram group as well. And do join the largest investor community in Singapore. So we will see you there. All right. So let me just stop share. Okay, so today is around 9 a.m. So thank you so much, Paul, for coming over to investing to do sharing. I think it's been some time since your last sharing with us also. So thank you so much coming to over this session and share with us. So we will see all the audience again on our next sharing session. Thank you so much, Paul.
Okay. Yeah. Thanks. Yeah.
Have
Thanks,
a good
everyone.
day and good night.
Yeah. Have a good week ahead, everyone. Thank you. Bye bye.
Thank you. Bye bye.